Okay, this afternoon we're going to talk about Handout 11, which deals primarily with the borrowing and loaning of money in real estate transactions. Most real estate transactions, because of the amounts of money involved, entail some type of borrowing. Usually, buyers do not have enough money, enough cash in their pockets to buy a piece of property outright without getting a loan from a bank or another party. So the vast majority of transactions take place in an environment where the bank is sitting here as a third party in every transaction, being the one who puts up very often a large majority of the money that's involved in the situation. Starting on handout 11, right at the beginning, a loan. A loan is a transfer of value from one party to another with the intent that the value will be repaid. It will be returned at some point in time. Right? To create a loan, and particularly a real estate loan, there are two basic documents involved. Now, if any of you have bought your own properties or have been involved in a commercial closing through your employment or the offices where you work, you'll know that closings today often entail hundreds of pages of documents. But the reality is, much of that is fluff, much of that is activities by the banks and the lawyers involved to protect themselves from being sued or being claimed to have been fraudulent or misrepresenting things. So that and a lot of it has to do with federal regulations and state regulations. The core bones of a transaction involve two pieces of paper, two documents. One is a promissory note, and the second one is a mortgage. And regardless of how many other hundreds of papers that you have, those are the two backbones of every commercial real estate transaction where borrowing of money is involved. A promissory note is a promise to pay a sum certain to order or bearer at a set date or on demand. It is a basic document in all lending, and whether it's a credit card or a car loan or a student loan or a mortgage, if you look deeply at the transaction, at the bottom of it all is a piece of paper that is some type of a promissory note. They come in various different iterations, various different ways they're written up depending on what type of borrowing we're doing, but it's all basically the same thing. It is an agreement whereby the borrower acknowledges they have gotten money or value and that they are indebted. They are legally required to pay it back from the person that they received it from. All right? Some of the basics about promissory notes. All right? A promise to pay a sum certain. A promissory note has to be for a set amount, although there are times when we're dealing with credit lines where there can be a maximum amount, and then the amount owed can go up or down below that maximum, but there has to be some amount. It has to be made payable to someone or to bearer. Payable to order means that there is somebody named in the note and they are recognized as a person of the right to receive payment. Payable to bearer creates a situation where we've almost made private money. A bearer note, anyone who shows up with it and says to the borrower, I want my money, just by virtue of possessing the piece of paper, they are the owner of the loan at that point and they have the right to be repaid. You don't see those very often anymore because the IRS and the other taxing authorities in the states do not like them because they are much too easy to move around, almost like cash. So there are all kinds of accounting rules that would prohibit them from happening, but every now and then we still do come upon one. Right? At a set date or demand. Most promissory notes have a set repayment schedule or a set repayment date by which they have to be paid back in full. But other types of documents, a personal check is a form of promissory note. And a personal check, even though it has a date on it, you are not supposed to post-date them into the future. You're supposed to put the date that you are writing them on the check, and it becomes immediately payable. As of that date, it is a demand item, a demand document. All right. Some basics to do with borrowing and notes. Principal. When we use the word principal in this connotation, we're talking about the balance that's owed. So if you are borrowing $100,000, the day you take out the loan, the principal balance of that loan is $100,000. If it is a direct reduction loan where every payment pays off part of the interest, part of the principal, then with every payment, the principal balance of that loan will go down. So it can vary from time to time. So initially it is the amount borrowed, but then as we go on with the transaction, people stop making repayment, it is the term we use for the amount that's still outstanding from the original debt. All right. Another word for this is principal balance, and that certainly means not counting interest, what remains to be paid on the note. What makes the world go round in banking circles and commercial circles is this little thing called interest. Interest is a fee that you pay for using someone else's money. Nothing in life is free, and certainly borrowing money isn't free. So when you borrow money in a commercial situation or to buy a house from a commercial lender, you are expected not only to pay back the principal that you borrowed, but you are required to pay interest. Interest is calculated by a rate, which is usually set as a percentage, multiplied by the amount owed by a period of time, and the custom and the legal reality has come in our system and the British system in Canada and Australia that if you say that a note is to be paid back at 3% interest, it is presumed at this point that it is per annum, per year, 3% per year. That is not necessarily true, and you can certainly have other methods, other time frames on which interest is calculated. But again, over the last several hundred years, it has generally come to be accepted that when you are paying interest, when we quote an interest rate, we're quoting it on an annual basis. All right. Term. Each note has a term, which is the amount of time you have to pay the note back. Okay. Now, ways that we determine interest rates. It's a very interesting process, and it's not an easy process. It's a difficult process for the average person to understand. Basically, each bank, each lender is free to set their own rates. However, there are other things that control, and there is competition. People are able to look around on the internet and other places today to find out who's offering money at what rates, so that as rates go up and down for various reasons, banks tend to follow each other. A couple of things that determine interest rates. Certainly, there are things called treasury notes and treasury bills. Every week, the United States Treasury auctions off notes, which are basically loans. People loan their money to the federal government, they're promised to pay back, and whatever rate that those are going for has something to do with how the banks set their rates for consumers. Certain types of promissory notes are tied into the treasury rates. In Europe and in the United States, there was something called the LIBOR, the London Interbank Offered Rate, which was basically a rate set by the major banks in London each day as to what they were charging for interest. This has come under scrutiny in the last few years, as it was determined that the banks were colluding to rig this rate in many situations. So while this was used extensively about 10 years ago, it has come to fall into somewhat of disfavor now. The Federal Reserve Bank also sets interest rates. What the Federal Reserve Bank does is it loans money to banks, and they charge the banks a certain percentage of interest for doing that. So of course, if the bank is going to loan money to you, this is how they make their profit, is on the interest that they collect. So if the Federal Reserve rate is 0.25%, the bank is not going to loan money to you at less than that rate. They're going to have some rate higher than that. So there are a number of things that go into fixing the rate, and they are quite fluid. And if you're looking to buy a house or a car and you pay attention for a few weeks, you will see how rates can fluctuate fairly quickly. And go up and down depending on what's happening in the larger economy. So again, when we're talking about rates, we're talking about interest rates. Now, most notes have something called a fixed rate, although there are adjustable rate notes. In a fixed rate note, the rate that you're going to pay for the life of the loan is set at the beginning of the proceeding. So as you sign the promissory note, you know that this is a fixed rate of 3.75%. Your interest rate will never be higher than that for the life of the loan, even if it's 30 or 40 years long. A word to the wise, particularly in commercial loans, this has not appeared in consumer loans except in credit card agreements at this point, but in commercial loans, I've seen it in almost everything that comes across my desk the last few years. Besides the fixed rate, the banks also set something called a default rate. Now, a default is when you fail to perform on the note, and the basic way that you need to perform on the note is by making payments. So if at some point in time you fail to make payments on time or make the required payments, then the bank can exercise what's called the default rate, which means that your fixed rate bumps up to a higher number. This is perfectly legal and allowed. I give warnings to all of you who have credit cards that be very careful, because the default rates on credit cards are up into the high 20s and some even in the 30% range. And an interest rate at that point compounds so rapidly it makes it almost impossible to repay a loan that has that interest rate attached to it. The basic promissory note that is used in commercial residential transactions, or residential transactions with commercial banks, commercial lenders, and credit unions, is a fixed rate note. It is usually what we call a direct reduction note. A direct reduction note means that if you take this loan out for 10 or 15 or 30 years, when you make the last payment, you will have made payment in full. The loan is broken down to a series of payments depending on the term. Every payment is for a certain amount, and by the time you get to the end, that amount of payment has been calculated, so every penny of interest, every penny of principal is paid in full. The opposite of this, which still exists, and you have to be careful, sometimes they're worthwhile, sometimes they're not, but you need to be aware of it, is something called a balloon note. In a balloon note, the final payment is a large payment, because the payments you've been making of principal and interest over the life of the loan are not sufficient to cover both principal and interest. So you get to the end of a $100,000 loan and you still have $50,000 to pay. This type of loan is still very common in commercial situations, although the federal government regulations tend to forbid and hinder banks from giving these types of loans to consumers. A direct reduction note has something about it called amortization. And amortization is that calculation of principal and interest so that we know what to charge you each month to make sure that you'll be fully paid at the end of the term. And if any of you have had experience with buying a home in particular, the way amortization works is that when you make your first payment, you're paying mostly interest and a very little bit of principal, because the whole amount of the loan is still out. As you make each payment, you're paying back a little bit of principal, so that the portion of your payment that is principal increases and the portion that is interest decreases, until when you get to the very last payment, it is almost all principal and just a small portion of it is interest. That is the preferred way to set up consumer mortgages at this point. The federal government and the state government regulatory folks are kind of insistent that the banks set them up that way. I will print up an amortization schedule and put it in the Blackboard notes so that you can look at it and see what that looks like. There are also things called adjustable rate loans and adjustable rate notes. An adjustable rate note is just what it says. The interest rate that you are charged can change. In many commercial situations, adjustable rate notes can change monthly or some even daily as the interest rate that the bank charges goes up and down. In consumer transactions, again, the federal regulatory folks frown on that type of situation, so most consumer adjustable rate notes have something called caps. And caps are basically limits as to how much the loan can change. A very popular product a few years ago was a loan with what's called a 2-6 cap. And what it means is that whenever a change date comes, the loan could go up no more than 2% at a time, and that over the life of the loan, it could only go up to a maximum of 6% above the initial interest rate. This is helpful to consumers because when you take out the loan, you can look into the future and can say, all right, this is what my payment would be if it even went up to the absolute worst interest rate, 6 points above what I'm being charged today. Sometimes you'll see what usually happens is that there is a term in the note, and it can vary. Very often, banks have been offering lately mortgage loans where they will be fixed for 5 or 10 years, and then they will become adjustable if you haven't paid it off in full by then. The banks are free to set the change date. Another term that you may see in financial publications or hear on the news is a reset date. And the reset just means that we've now come up to the time where your next monthly payment is going to be calculated under the new interest rate. The federal government is fairly adamant, and the courts also were adamant about this when adjustable rate notes first became popular in the late 1970s, early 1980s, that the bank has to have some method of determining what the rate will be. So there usually is a reference to an outside index, and again, this is where Treasury notes or where the LIBOR may come in. It will be written into your adjustable rate note that 30 days before your change or reset date, the bank will look at what the LIBOR is or look at what the Treasury notes are selling for and will add a certain number of points to that number to come up with your new interest rate. The idea here being that the interest rate has to be completely calculable by each side, we can know with absolute certainty what it should be. So therefore, it cannot just be based on the whim of the bank. It must be tied to some outside index. There are certain things which I mentioned before, certain loans fixed adjustable, where the loan is fixed for 2 years, 5 years, 10 years, and then becomes adjustable after that. Not very popular at present. Under the real estate realities and low interest rates of the past few years, these have not really been popular or been an issue. But if you went back to 2006, 7, and 8, to the real estate boom of the prior decade, these were very popular things. Something called a negative amortization adjustable payment note. Now, negative amortization means that your monthly payment is so low, you are not even covering the interest that accrues on the loan during that month. And therefore, every month that you're in the negative amortization period, instead of paying the mortgage down, you're actually increasing the outstanding balance. The amount that you owe is going up. Many people signed on to these in the early 2000s, not understanding what they were, and after a year or two went to sell the property, refinance, only to find out that they were tens of thousands of dollars deeper in debt than the day they had started, even though they had been making thousands of dollars of mortgage payments every month. The negative amortization has to be paid for at some point. So what happens in these loans is they get you to take the loan. They get you to sign up by giving you an artificially low payment, but then at some point during the course of the loan, that payment is going to have to adjust, not only to go up to the true interest rate, but to also cover all the unpaid interest that is accrued up until the change period. During the last financial crisis of 2008 to 10, many people, one of the things that triggered the crisis is they took these loans, they were paying very artificial loan payments, and then all of a sudden 2 or 3 or 5 years into the mortgage, the real payment came in and they were unable to meet them. They were so far above what they had been paying, and of course nobody had really made it clear to them that this would happen or how severely it would happen. Right? One of the things that was very popular 10 years ago but has pretty much disappeared, although I have still seen some of them, is something called an option adjustable rate mortgage. In an option adjustable rate mortgage, the borrower basically gets to set the initial terms. So they can determine what my monthly payment's going to be, how much of that principal and interest. They can even make it a negative amortization initially, and they will pay that lower payment. But then again, at some point 3 or 5 years into the reality of this loan, the loan resets, and you not only have to pay what would have been the normal interest rate or interest payments, monthly payments, principal and interest payments, you also have to make up for lost time for everything that you had not been paying if you were doing it a negative amortization. All right, moving on to mortgages. There are a number of different types of mortgages. Now, I talked about this a little bit in the last section, but I'm going to repeat it again. In colloquial English, and not just in Rhode Island, but in everywhere, and even bankers do this, we use the term mortgage incorrectly. We all say, I'm going to the bank to get a mortgage. You are not going to the bank to get a mortgage. You are going to the bank to get a loan. You are giving a mortgage on your real estate to the bank. Parties who loan property like security. Security is a concept that there is some piece of property, something of value out there that if you don't repay the loan, the lender can go take that thing of value and they can use that, sell it to get their money back. So in a transaction to buy a house or another type of real estate, the security is the real estate itself. You go to the bank, you borrow money to purchase your house, and the minute they give you the money, they're having you sign a document, a promissory note saying the money was borrowed, and a mortgage saying that they have rights now to the real estate. If you do not repay, if you default, if you breach your agreement, they have the right to take the property and sell it to get their principal, interest, and legal fees back. Okay. Different types of mortgages. There are institutional first mortgages. Now, and when I'm talking about these, I'm going to be talking mostly about consumer mortgages for the next few minutes. When you get into commercial lending, there are whole different variations of what can be done. But in residential lending, again, the federal government, the state governments have stepped in with regulations, so there's only a limited number of different products that exist. An institutional first mortgage is a mortgage that you will get from a bank or a credit union. It would be a first lien on the real estate, which means the real estate had to be free and clear. There could be no other liens or charges that would come prior to the bank, so that if the bank needed to foreclose, they stand first in line and they are going to get paid. Normally, they would only lend to what we call an A credit borrower, somebody with very good credit, and we'll talk about that a little more in detail in a couple of minutes. Usually, they would only loan up to 80% of the value of the property, which means that you have to be prepared to put down 20% of the value of the property plus closing costs. That doesn't sound like a big number until you start thinking about what houses are valued at in this part of the world. A $100,000 house, of which there are none in New England, would require a $20,000 down payment. A $300,000 house, which is much more likely to be the cost of a piece of property in New England, would require a $60,000 down payment, plus whatever the costs were to have an appraisal done, to pay for the bank's lawyer, to have the title exam, title insurance, all the other homeowners insurance, all the other happy things that go along with a residential closing. Another type of mortgage is called an equity mortgage or a home equity line of credit. These are second mortgages. These are mortgages where you have owned a property, you may be paying on your first mortgage and you've paid it down to the point where the house is worth $400,000 and the mortgage is only $200,000. There are lenders who will loan you money based on that equity, that value of the house that is yours, that is not the bank's, and they'll do everything in their power not to call it a second mortgage, because in New England, coming out of the Great Depression in the 1930s, second mortgages had very negative connotations. But the reality is anything that's called a home line of credit, an equity line, anything that's tied into your house is a mortgage. These are usually easier to get. They usually do not have the same requirements as a first mortgage, and very often they'll let you borrow up to 100% of the equity value of the property. All right. For people who do not have 20% to put down, which the most younger couples do not and have not ever, the federal government and the state governments have come along to assist in this process. The Veterans Administration allows veterans to borrow at 100% of the purchase price of the property or the value of the property, and the VA guarantees to the lender that if the person forecloses and the lender uses any money, the Veterans Administration will pay them. The FHA, the Federal Housing Administration, does the same thing for non-veterans. They usually will not go up to 100%, but they will go up to 95% of the value of the property and allow you to borrow that. And then within Rhode Island and Massachusetts, there are agencies called, in Rhode Island, the Rhode Island Housing and Mortgage Finance Corporation, and then Mass Housing, where they also have different types of mortgages that allow you to borrow more than 80% to help those particularly first-time home buyers who don't have the 20% equity. Even some of the commercial lenders, institutional lenders, will allow you to borrow more than 80%. However, they will require you to obtain something called mortgage insurance. And mortgage insurance is just what it sounds like. It's an insurance policy that you pay for each month, and it guarantees that the bank will not lose money on you should they have to foreclose. And with that insurance policy in place, they will be willing to lend you more than 80% of the value of the property. Now, this will increase your monthly payment, so that means you have to have the income sufficient to show that you can pay the principal and interest payment of the mortgage plus the payment that is due for the PMI or private mortgage insurance. But it is another way that folks use to buy a house before they have saved up money for a down payment of 20%. These situations were unregulated for a very long period of time, but beginning about 15, 20 years ago, the federal government got involved in regulating them, and now there's actually a system whereby if the value of the house goes up dramatically, or if you've made sufficient payments so that based on the original purchase price, you've now paid the loan down to 80% of value, that the PMI will drop off at that point and you no longer have to pay it after that. So for many people, hopefully, paying the PMI will only be a 2 or 3 or 4 year thing, and then they'll get to the point where they have 20% value in the property and they can go along just paying the principal and interest on the mortgage. A number of years ago, the federal government realized and the bankers realized that there were hundreds of millions of us baby boomers sitting out there with tremendous amounts of equity tied up in our houses, but very many of us with very little income, relying on only Social Security to survive. So in a sense, people were house poor. They would own houses and have $300,000, $400,000, $500,000 of equity tied up in the house. However, their monthly incomes were so low they were barely able to keep up with the taxes and insurance, water, sewer bill that goes with a piece of property. So the federal government, working with the banks, came out with something called a reverse mortgage. In a reverse mortgage, what happens is that the homeowner is allowed to borrow money. They do sign a promissory note. They do sign a mortgage. The bank and the federal government, HUD, take mortgages on the property. However, the homeowner never has to pay that money back ever for any reason. They get that money. They don't have to make monthly payments on it. Now, interest does accrue on it. So in the promissory note, there is an interest rate. And how these loans are set up, they're called no recourse loans. And what that means is the banks and government's only means of getting repaid is that they have to take the property and they are repaid from the sale of the property. Again, there are all kinds of arguments about whether these are good or not good. Certainly the way the interest rates work on them, if you take out a reverse mortgage and then you live for 10 or 20 years, there will be no equity left in your house for your children or your beneficiaries when you die. However, if it's a difference between losing the house because you cannot pay the taxes and the insurance or living in total poverty to keep the house, for many people they do become an option that allow them to live somewhat more comfortably. These loans are written in such a way that if the owner of the property can no longer reside in it or chooses not to reside in it, then the loan will become immediately due and payable, and upon the death of the owners of the property, the loan will become immediately due and payable. So at that point, their heirs have a choice of, if they think there's equity left in the house, of selling it and repaying the bank and the government within a certain period of time, or of just letting the government come and take and foreclose the property, get back whatever they can get back by the sale. All right. A little bit of background about loans and mortgages. I want to move into now, how do you get a loan? What do you have to do to obtain a mortgage? There are a number of qualifications for getting a loan. They don't just give money to anyone, even though sometimes it appears that way. First of all, you have to have good credit. Credit is a rating that is kept about you, and it basically is a summary of how you have handled money in the past. Now, many people think that the government, either state or federal, maintains this system, and it is not at all a government system. It is entirely a private system. It you originated at the turn of the 20th century in the 1900s by the merchants in each city and town who are extending credit, setting up an organization that would keep track and compare who was and who wasn't paying their bills, because the realization quickly arose as merchants began to extend credit that if somebody wouldn't pay one merchant, they were happily not going to pay other merchants. So every city or town of any size by the 1920s or 30s had credit bureaus that were keeping track of people's records for the business people, and the business people would pay for these services to keep these agencies going. With the advent of nationwide banking and credit cards, just like with the banks and everything else, these tended to merge and be bought out, so that now there are basically three privately owned credit card companies that take your information, store it, analyze it, and will give it back to whoever becomes a member and wants to purchase it from them. When you go to borrow money to buy a house, they're going to look at your credit. Number one, they're going to look at how well you have paid back in the past. Number two, they're going to look at what is the amount of your credit compared to your income. And there are certain ratios that the banks apply. Usually, your whole mortgage payment cannot be 30 or 35% more than your take-home pay. And your entire debt service, so that would be car loans, student loans, credit cards, anything you can think of, cannot be more than 45 to 48% of your take-home income. If you have borrowed a lot of money and you are paying it back faithfully, you still may not get a loan to buy a house, because when they look at these ratios, they're going to say, well, yes, they've been very good at making payments. However, their income is not sufficient in our minds to support paying for the house and paying for all the other debts they have outstanding. Today, one of the things that the credit bureaus do is they had gotten sued for discrimination and for falsely excluding people at different times in the past. And so beginning again about 10 or 12 years ago, they were desperately seeking a way to do some kind of statistical analysis that really wasn't within their control. And a company called Fair Isaacs and Company came up with a computerized score system, which, using the initials from the company, came to be called a FICO score, F-I-C-O. And what this system does is it takes all your credit information, it runs it through a computer, and then based on the algorithms that have been programmed into the computer, it pops out a number. And that number can be anywhere from the mid-1800s down to the 300s. And of course, the higher your number, the better your credit standing, and the better chance there is that you're going to get a loan, and very often the better interest rate that you will get on a loan. Today, to get a institutional first mortgage, you really need to have a FICO score up in the 700s, and the high 700s would be better. If you have a score in the 600s, you can still get a loan, but you're not going to get the best interest rate, and you're not going to get the best terms, and you may be forced to take an adjustable rate loan as opposed to getting a fixed rate loan. All right. The three major credit bureaus are Equifax, Experian, and TransUnion. You can look them up online. All you'd have to do is Google credit bureaus. And one thing that is good, that under federal regulations that came into play a number of years ago, you are entitled to a free report from each of these agencies every year. So at no cost to you, you can go on, you can give them your social security number and address and birth date, and they will generate a report, and they will show you what it is they are telling to their members when you apply for credit. Okay, another thing that you need when you are purchasing real estate and you're going to use a mortgage on that real estate as security for the loan is that you have to have an appraisal done. In the old days, many of the banks and lenders had their own group of people, mortgage department people, who would go out and value a house and determine what it was worth or not. As the federal government became more involved in the process and became the guarantor and insurer of last resort for most mortgage loans, that has faded away. And now there are appraisers who are certified. They have to go through an education process, they have to go through a testing process, they receive a license from whatever states they operate in, and they are hired by the bank each time the bank wants to loan money to determine a value for the property. And the amount of money you're going to be able to borrow will depend entirely on that appraisal. And it's a very difficult thing because there's very little appeal from the appraisal. Unless the appraiser was totally asleep on the job and made something that is an absolutely obvious mistake, it's very difficult to question the appraisal and how it's generated. It's all done by computer at this point in time. The number of listings of properties and records of sales of properties that are online is humongous at this point, so there's lots of data. The computer programs operate on their own sua sponte at this point in time, so it's not like the appraiser can put their finger on the scale and turn the appraisal higher or lower. They're really bound by what the computer is spitting out for them, with some few exceptions. There are times when a property is very unique, has a certain condition, good or bad, that we don't find on other properties, where the appraiser's own personal knowledge and idea of what this condition does to the value will come in. But those are rare, and the banks frown upon that, and the federal government frowns upon that even further. The reality again being, if the bank is telling you they'll only loan you 80% of the purchase price of the property, even if you think the house is worth $500,000, if the appraisal comes back and says it's only worth $375,000, the bank is only going to lend you 80% of the $375,000. You're not going to be able to even get 80% of the sales price. When people are selling properties, most real estate agents, particularly if they work with some of the larger companies, have available to them computer programs, market analysis programs. And a market analysis is not a formal appraisal. However, many of the larger realty companies are able to produce market analysis that mimic the appraisals very closely. So one of the things that you need to do as a seller, if you are thinking of selling your property, you bring in a couple of different real estate agents to look at it, and they're giving you a certain price, and you think the property is worth way more than what they're telling you. Even if they agree to list it at that higher price, you're going to run into issues, because even if you get a buyer to come in and pay the higher price, unless that buyer has a tremendous amount of cash put down, when they go to have an appraisal done, they're going to run right into the records, into the valuations that are out in the open market, and if they need to borrow money, they're not going to be able to borrow sufficient money to pay an inflated price. So the appraising has become much more specific, much more accurate over the last few years, and it really ties both buyers and sellers to a certain number, because very few people are walking around with enough cash in their pockets to be able to ignore the appraisal and pay something dramatically more than what the appraisal says the property is worth. All right, moving on. Who lends? When somebody is loaning you money, who are we talking about? Who are the basic entities in our society that loan money, that provide the financing for real estate transactions? First and foremost, there's a bank. A bank is a private institution. They are not owned by the government in this country. They are private. They are owned by shareholders. They are highly regulated by both the state and the federal government, so that while they're not owned by the government, sometimes it seems like they are run by the government, because they do have a tremendous number of regulations that they must follow. The basic job of a bank is to accept money on deposit. So they take money from depositors that the depositors do not need to immediately spend or use, and then they take that money and invest it. And one of the basic ways that they invest it is by loaning that money out at interest to other people. Then when the interest comes back in, they use that interest to pay their bills, pay the salaries, pay the light, the heat, the upkeep of the building, to pay their shareholders, and they actually, at some point in time, although lately it's been almost nothing, they'll even give interest to the depositors. Now, Commercial banks are the banks that we normally think of: Santander, Citizens, Bank of America, um, Chase, although there are not many Chases, Wells Fargo's, there are not many of them around here. These are banks that are full service banks, interstate banks. They can move from one state to another. They have branches, some of them like Bank of America, all across the country. And they perform the basic operations that we consumers think about. They maintain checking accounts, they maintain savings accounts, money market accounts, they process and clear checks, they can wire money for us, they can provide us with bank checks for transactions where they are required. They basically deal with the public, with consumers. Right? There are also banks called investment banks. These are banks that handle the sale of corporate and municipal bonds, loans to corporations and to governments, and also securities, which runs securities, a whole realm of things such as stocks and derivatives and other types of economic products that are out there that people, particularly in the financial world, buy and sell and trade. These banks do not take deposits from the public. You cannot walk up to Goldman Sachs in New York and say, I want to open a $20 account and have my checks run through you. Most countries in the world have a central bank, and that central bank is tied in with the country's treasury. So that central bank is involved with collecting taxes, with issuing a currency, with handling the loans and debts of the government, as well as supervising what goes on in the general banking system. The United States does not have a central bank. None was provided for in our Constitution. In the early days of the Republic, in the early 1800s, Congress tried to establish central banks several times, government banks, and they were generally came to be quickly hated by the people and lasted for a few years, and then as political parties changed, they were quickly undone. Beginning in 1913, after a series of contractions where the economy had gone into bad times, and it had happened a number of times in a row, the bankers of the world finally convinced the federal government to come up with a hybrid system for our country. So they established something called the Federal Reserve Banks under the Federal Reserve Act. Again, the Federal Reserve Banks are not owned by the federal government, even though their name would imply that somehow they're tied in. They are tied in the sense that the federal government regulates them, and the president and Congress get to appoint a certain number of people on their boards, and certainly they get to appoint the head of the Federal Reserve System. However, the Federal Reserve Banks are owned by their member banks, and they basically act as clearinghouses for the other banks. They are there to provide funds, to provide loans, to make sure that the system keeps liquid and moving at all times. There are 12 federal banks. Each one has a certain territory. We are under the Federal Reserve Bank in Boston. There is another one, the Federal Reserve Bank of New York, and the Central Federal Reserve Bank in Washington has supervisory power over all of the other 12. The power of the Federal Reserve is very great because one of their basic functions is to loan money to the other banks. One of the things that happens is when you go to deposit money in the bank, let's say you get a $10,000 bonus from your job, you deposit in the bank. The bank immediately turns around and loans that out as part of a mortgage, part of a car loan, something else, so that if you come the next day and say, oh, I need to take my $10,000 out right now, they have to have another place to get money. Your money has already been loaned out. Normally this works okay without the amount of money coming in and out is sufficient if the bank is being properly run, but there are certain choke points in the economy each year. In the couple of weeks before Christmas and New Year's, people need cash. People want to buy things. People are wanting their lines of credit to be extended. People want to have money in their pocket. They want to give it as gifts. So it's almost like the pig in the python. All of a sudden there's a tremendous bump in the system. All the banks need more cash than they would carry on hand in July or August, and they need a place to get that. They don't want to put a sign on the door saying, we ran out of money, we can't give you any today. Matter of fact, it's illegal for them to do that at this point in this country. So what happens is the Federal Reserve has money on hand, and at that point they would loan the bank's money to tide them over this period. And after Christmas, as all this money comes flowing back in from merchants and from people who got gifts, the bank uses this new cash to pay off the loan to the Federal Reserve. Because the Federal Reserve charges the bank interest rates, this kind of sets a floor for what interest rates the banks are going to charge consumers, because they have to be able to make money on the loans, and that includes paying money back to the Federal Reserve. The Federal Reserve acts as a clearinghouse for checks and wiring of funds, so the way that money can move easily around our system is basically the result of the Federal Reserve being there and being in place. Now, the banking system has gone through a tremendous amount of crisis in the last 10 years. It seemed to have been stable for a while. With the effects of the coronavirus and so many of us being out of work, and so many places being closed down for so long, all bets are off as to what will happen next. So things could become interesting, hopefully not. The Federal Reserve has been printing money like there is no tomorrow to try and cover this situation, to keep everything flowing. And hopefully what they're doing will work, but there's no way to know. We'll just have to watch and see. Some of the things that worry bankers, that keep them awake at night. Number one is liquidity. Liquidity is the ability to readily exchange an asset for cash, to be able to provide money, to be able to keep the ATM machines operating with cash as people roll up and want to take it out. Right? If a bank becomes illiquid and they have no cash, that has a tremendous psychological impact on borrowers. Borrowers begin to be afraid. What happens if I can never get my money out? So the goal of every banker is to remain liquid, to remain in a situation where whatever people show up today saying, I need cash in my pocket, the bank has sufficient money to cover that and pay it. Another thing that worries bankers is something called reserve requirements. Even though the banks take the deposits and loan them out, they are not allowed to loan out 100% of the deposits. They have to keep something on reserve to make sure that they do maintain liquidity. And both the state and federal governments have a number of laws and rules about minimum reserve requirements and what the banks have to do to be declared liquid and solvent by the state. And that involves not just how much cash is on hand, but it also, for the state regulators, involves balancing how many loans you have to students, how many loans you have as mortgages, much credit card exposure do you have, how many personal loans, car loans. They look at the makeup of what the bank is lending, and they don't want them to get too heavily involved in any one area, because if one area of the economy goes down, you don't want the bank to be 99% involved in that, because that will create havoc and possibly cause the bank to have issues going forward. Leverage. Leverage is the idea that by borrowing a small amount of money, or by actually putting in a small amount of cash, you borrow money, and that borrowed money allows you to secure an asset or funding far more valuable than the amount of money you ever dreamed of putting in. People who play the stock market professionally, people who are involved in real estate investing professionally, people who are involved in initial public offerings of corporations, people who are involved in the commodities markets, buying and selling grain, cattle, hogs, corn, minerals on a large scale, are very much attuned to the idea of leveraging, and of course they are very much into the idea of putting in as little of their money as possible, borrowing as much money as we can, and turn that around in a big deal, a big sale, so that we can pay everything off and have money in our pocket to be able to make money. And the general idea is the bigger the deal you can pull off, the bigger the leverage, the bigger the money you will make in the end if it goes well. The problem is if it doesn't go well, you're now in a situation where you may be defaulting on your loans, and then the bank is standing there holding a loan that will not be repaid. So one of the things the banks try to do is to scrutinize what it is you're going to be doing with the money you borrow from them, to make sure you're not putting yourself in a situation where you've created so much leverage that if the slightest thing goes wrong, you're not going to be able to pay back this loan. We have not seen it recently, but it certainly was an issue in 2009, 10, 11, and 12. The values of real estate dropped precipitously when the economy had a downturn. And the values had gone up higher than had ever been in history, and they had gone up very quickly. And then suddenly, almost as quickly as they went up, they came crashing back down. Well, for the lenders, this is a nightmare scenario. It creates something called an upside down property. Upside down means that the amount the owner owes to the bank is well in excess of what the value of the property is, what they can sell it for. In an upside down property situation, it's very tempting for the owner to give up and just say, I'm going to stop making payments, let the bank seize the property, and then chase me to see if they can get any other money out of me. One of the things you must remember that in most residential transactions, at least on the East Coast, if you lose the property at foreclosure and there's insufficient funds to pay back the bank, they can still chase you. It is a recourse loan. They can still come after you on the promissory note for the balance. This is very true with car payments also. You always have to make sure if you buy or lease a car that you carry sufficient insurance to cover something called the gap. There is a period of time where the cars devalue so quickly, where the value of the car is going to go down below the amount of the loan or the amount of the lease that you owe, and you need to make sure you're insured for that, because if something happens to the vehicle, if you do not have that gap coverage, the insurance company is only going to pay you the value of the car, which sometimes can be $5, $6, $7, $8, $10,000 less than what you actually owe to the bank. So upside down properties present a nightmare for the lending community, and they certainly were a nightmare for the banks and the federal governments during the period of the last downturn. We're now in the middle of this page. The term equity we talked about before, but just to make it clear, equity means the amount of value above whatever is mortgaged or whatever is securing a loan. So if you owned a house worth $200,000 and you had a $100,000 mortgage, we would say that your equity in the house as a homeowner is $100,000. Okay, I'm going to stop there, and then I will continue. We still have a little bit more of section 11 to go through, and I will move into section 13 after that.